Good morning. Welcome to Trading Hour, the day after, and things are very, very quiet. No gains, no losses in the benchmark indices. I'm Reema Tendulkar, with me are Pavitra Parekh and Surabhi Upadhyay. Quiet, right? Very, very quiet. We thought that, after all the action of yesterday, last night at midnight, there would be some volatility today, some activity, but things are absolutely flat. That said, Asian markets have actually reversed. In the morning, markets like Hang Seng were trading in the red, but the Hang Seng is now up close to about 0.7%. The Taiwanese market has a gain of close to about 0.5%. So Asia, it's still a mixed picture, but there has been a bit of an intraday recovery. Drilling it down to individual stocks and sectors, IT is on the back foot. The Nifty IT index down 0.8% for the day. For the week so far, it's lost about 3% with names like Infosys, HCL Tech, Wipro taking it on the chin. Reliance Industries attempted a big breakout and a big up move at the beginning of this week, but today it's fizzled out a bit. So Reliance Industries is down close to about 0.5%, but there is action, which you can see. Reliance Industries is now down over 1%, so it's extended the fall on the way down. 1.25% gone on Reliance Industries, so giving up all of those early week gains. Autos having a good session. Tata Motors, Maruti, M&M on the gainers list. Hi, what are you tracking?
Hi, good morning. So like you said, it looks very, very quiet now, but we have come around 90-100 points off the day's low. So I think we will take that quiet. The advanced decline ratio is still quite positive, So we do have around 1,600 stocks which are gaining for around 1,100 which are losing. So that is still looking quite all right. Take a look at some of the mid-cap IT names. The mid-cap IT index overall this week, of course, is not doing well. It's down 3%. But take a look at some of the mid-caps today. The larger ones also, of course, the biggest losers on the Nifty today. Something like a Persistent, LTI, Mindtree, Birlasoft, all of these seeing pretty steep gains right now. All of the oil and gas players are in focus as well. So take a look at BPCL, HPCL, IOC. These ones are seeing a bit of a slip. And, GAIL on the back of the integrated tariff hike that came through yesterday. That one is down, but Mahanagar IGL holding up well. We also spoke to the managements this morning, so we'll get you a word from them later on this show. What's also not doing well is Asian Paints. Of course, there's a brokerage note that came out on Asian Paints, but you're also seeing Berger Paints decline. It's down almost 3% right now, so do keep that on your radar. And once again, for the banking names, we are seeing that split, right? So yesterday we saw the private banks really dragging and the PSU banks doing well. It's a complete reversal today, and we're seeing a little bit of the opposite picture play out, Surabhi.
Guys, I think I would call it a what now market.
Yeah.
So it's all done. We've had these many bank blow-ups, you've had the ECB hike, you've had the Fed hike, and it's a what now moment for the market. Let's just pull up the contribution plate. You folks have discussed a lot of the stocks that are moving around, and there's a perfect offset. So, you have these IT names falling, Reliance falling, but you have a bit of a up move on a ICICI Bank. So it's literally netting itself out, and we don't have any sense of direction, and a very, very tight range is what we've got. So ITC, Axis Bank, ICICI Bank on the upside, and then you have Reliance and the tech boys with the counterweights on the downside. I really want to just get to the big news point that set the context yesterday, as we got that 25 basis points rate hike from the US Federal Reserve. Well, after that rate hike came through, we also, of course, heard commentary from Jerome Powell. This is, of course, the 9th hike that the Fed has delivered since March 2022. The Fed expressed caution about recent banking crisis, and it also indicated that hikes are perhaps nearing an end. Let's listen in to what Jerome Powell had to say.
Inflation remains well above our longer-run goal of 2%. In February, the 12-month change in the CPI came in at 6%. And the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. We published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Everything was fine up until then because the market took this as a dovish hike. It was along expected lines, but then came the quote from the U.S. Treasury Secretary Janet Yellen. I just want to put that quote up. It was that single one line that completely derailed the bull's case because the Treasury Secretary came and said, "I have not consider or discuss anything having to do with blanket insurance or guarantees for bank deposits. And that was contrary to at least what a section of the market was building up in the form of a hope trade. And therefore, there was an unwinding of that hope trade that literally played out. Let's just discuss this further with our first guest on the show, Abhilash Narayan, Senior Investment Strategist of Group Wealth Management at Standard Chartered Bank, is now joining in. Thanks very much for being with us this morning. And my first question really is that the market in a what next and what now mode, given that a lot of these big announcements and events are out of the way. So, Abhilash, how would you look at India and playing the market here now?
Right. Thanks for the question. And obviously, a lot has happened in the past week or so. But, we have two more central bank meetings later today. So we've got the Bank of England as well as Swiss National Bank, who will be announcing their rates later on today. And I think the most closely watched one would be Swiss National Bank. Obviously, we've seen the saga between Credit Suisse and UBS play out. So it would be very instructive to see whether they are still focused on fighting inflation and raising rates, or does the banking sector stress lead them to sort of put a pause or slow down on the path of rate hikes. But I think as far as equity markets are concerned, be it India or global, we think that the markets are likely to remain choppy. Volatility is likely to remain high, at least for the next few weeks, till we get a bit more sort of easing off of the concerns at the moment.
So would you stay away from equities altogether, be on the sidelines because of this lurking risk now in global equities? Because even if something happens in the US, there are repercussions, there are linkages, which drags the Indian or the Asian markets lower. So what's the call on emerging markets now? And then if you could, talk about US and then India.
Absolutely. So as far as Asia Japan equities are concerned, we are overweight on the region. And in fact, we are neutral on US equities. So we do prefer emerging markets, especially Asia, over US and European equities. And the reason for that is simple. While, India, China, Indonesia, Malaysia are expected to post, healthy GDP growth, in US and Europe, we assign around 70% probability of recession over the next 12 months. So the stronger economic backdrop should be positive for Asian equities. Now, within Asia, we are neutral on Indian equities and have an overweight on China. And the key reason why we are neutral on Indian equities is because we think that on a relative basis, they are trading expensive. So I think they're trading around 55 to 60% higher on a PE ratio compared to MSCI Asia Japan. So that valuation premium is likely to be sort of something that caps further upside in Indian equities or relative outperformance of Indian equities.
All right, Abhilash, we were going through the comments that came through from Powell as well as Janet Yellen, and it is a little bit in contrast, right, what came through. So what is your reading of that? And are you also someone who believes that this entire banking story is likely to subside in the next couple of weeks, and then the Fed will perhaps go back to, the complete focus on the inflation fight? How do you think that's going to play out, and how are you reading these slightly contrasting comments that came through?
Well, if we start with the Fed, Fed is in a tough spot right now, and the comments from Fed Chair Powell do sort of indicate their constant focus on inflation. Because if you look at the underlying drivers of US inflation, some of the core inflation drivers such as shelter or housing and service sector inflation are actually accelerating despite, the 450 basis point hikes we have seen in the cycle before the latest hike. So inflation is a concern. And if you look at Fed's own projections, they do not expect inflation to come down towards 2% by end of 2025. So that's almost 3 years out from now. So Fed is focused on inflation. And I think the risk here is that the Fed over tightens and we end up seeing US economy slow down. In fact, there are some people in the market who believe that Fed is concerned about the strong labor markets and would like to see unemployment, just edge up a little bit so that, wage pressures do subside in US. Now, as far as Janet Yellen is concerned, obviously, there was some hope that banking sector in US would get a blanket sort of insurance, which will help ease the concerns around regional banks. But, we saw the statement, what it was. And that's, one of the key reasons why we saw the banking sector decline quite sharply. Now, as far as the regional banks are concerned, we think that this, while the near-term stress may subside, there is going to be more regulatory focus on the regional banks, and that could keep the sentiment around the US banking sector, a bit more subdued. And that's why we think that healthcare sector is one which is likely to outperform the financial sector in US over the next 12 months.
Abhilash, got that. And that's a very fair and valid point. But I just want to come to your view on India. You said that you're neutral on India. You're still overweight on China. And that's interesting because we were speaking to, some of the strategists at some of your peer banks. Got a view from JP Morgan, also from HSBC, if I remember correctly. And the view there was that perhaps this sell India, move to China trade, which started at the beginning of 2023, that's petering out. It's on its way out. You don't think so? Why the neutral stance on India despite the valuation correction that the market here has seen?
Right. I think that's a valid question. And if you look at it, over the past 1 month, Indian equities have outperformed Chinese and the broader Asian markets. So we have seen a bit of a catch-up to the underperformance of Indian equities that we've been seeing for the past few months. Now, if I look at the next 3 to 6 months, obviously, there are some very positive factors for India. GDP growth is expected to be around 6% in FY24. Earnings, we expect them to grow by around 15%. But it's just the fact that, valuations are expensive, not only relative to Asia, Japan, but also versus, the long-term average. If you look at Nifty, so long-term PE ratio is around 17 times based on our estimates. So we think that elevated valuations, especially when you're thinking about potential recession in US and Europe, are just going to be something that caps the performance. If you think about China, obviously we've seen a bit of profit taking after the 50% rally that we saw since October, but we still think that the market may be underestimating the earnings growth there, and that's on a relative basis. We think China may outperform India, but if you think about it from a global perspective, we do expect Indian equities to outperform both US as well as European equities.
You said India is trading at a valuation premium of 55 to 60% to the region. What, according to you, is the fair valuation premium India should command? How much lower does that...
That's a tough question. Yeah. Well, I think depends on the environment and the flow picture, right? So historically, India has always traded at a premium relative to Asia, Japan. So what's the fair premium depends on the economic regime. But we think that, given the fact that the current account deficit is still sort of elevated, it's come down. It's been held by lower oil prices, but it's still something that we are watching. And there's obviously the risk that, if we do see a recession in US and Europe, you could see some outflows from emerging market equities and bond funds. So that's what's sort of keeping us from being a bit more optimistic on India just as yet.
Okay, so, you are saying that even though valuations have corrected, perhaps not enough to, find comfort. Are there pockets within the market where you think that has happened, which, now appear at these levels more attractive?
In general, if you think about Indian equities from a market segmentation perspective, we like large caps over mid caps and small caps because we think that large cap names are more defensive and they have more buffer as far as balance sheet strength is concerned if we do end up seeing a global economic slowdown. But if we move to sectors, we prefer the more domestically oriented sectors. So sectors like banking, which is obviously benefiting from improvement in asset quality, but also sectors which benefit from India's infrastructure push. So industrials, construction related companies. We would be a bit more cautious around the IT sector and pharma sector, which are more dependent on export-related earnings or earnings from abroad. So domestic over international sectors would be our pick within India. Sorry.
All right, Abhilash, we got that. Thank you very much for joining us and taking us through your call in the market, and as well as, how you really see India positioned within the broader Asian landscape. But that is the word coming in from Abhilash Narayan, still saying that, valuations have corrected a fair bit for India, but it's still perhaps quite expensive compared to what we're seeing in the rest of the region, commanding around a 55 to 60% kind of premium. But with that, we are going to get into a short break on the show. On the other side, we're going to shift focus from equities to talk about what's really going on in the world of commodities. Manisha will be with us. Welcome back. You're still tuned into Trading Hour here on CNBC-TV18. We have been talking about the equity market, so let's talk about the world of commodities now. Manisha is here with us, and she has put together a very interesting piece on the profits that some of the world's biggest commodity traders have seen. They've hit a record high in 2022. So Manisha is here with that. Manisha, these are some big numbers that you have.
Yes, Pavitra, and the numbers haven't gone down in 2023 as well. pardon me, if you look at the first quarter of 2023, the numbers even now continue to be very strong. I mean, look at the kind of volatile moves we've seen in many of these commodities. So, well, yes, the profit margins have just about continued to go up. But this is the 2022 data where the global earnings for commodity trading companies has hit a record $115 billion. I mean, this is the highest by far. And I'll give you a comparison on what we've done in the previous year, and you'll understand on where these numbers stand at this point in time. So I'll start with Glencore, and we have seen the net income here go up by nearly 17.3 billion. Now, this is 3 times or threefold higher than 2021. I mean, that's the kind of work that they've done, and Glencore does agro and non-agro, both of these commodities. Moving on, and we'll talk about Mercuria and Trafigura as well, where the net income stood at $7 billion, and that equals combined income of last 4 years for them. So that's how 2022 panned out for Trafigura. Trafigura also deals with metals and energy as commodities. Now, Whitehall is by far the largest trader when you look at energy and crude oil there, and their turnover was $505 billion in the previous year as compared to $279 billion in 2021. So almost doubling of what we've seen in 1 year coming in from Whitehall as well. Moving on, you also have Mercuria, where their net income was at $3 billion, double of $1.25 billion that they did in 2021. And as I said, the major commodities that have given them this income clearly has been gas, power, electricity, crude oil. This is where we saw the major movements coming in from, and not forgetting carbon trading, because this is another one which saw very huge trading volumes coming in from Europe and China and US as well. Well, the reasons that you saw huge volatility in commodities was, one, it was Russia-Ukraine war that already led to a lot of supply concerns into the market, and the speculative long positions continued to gain up. There has been extreme volatility in energy markets. In a span of day or 24 hours, we saw the crude oil prices move anywhere between $3 to $7 in matter of a day, and that is what led to profits as well. And then came the economic activity, rebounded after post the pandemic. Demand also rose in 2022. There was a lot of pent-up demand coming into the markets. That led to the markets higher. There was also a demand-supply mismatch, because during the COVID periods, we saw the supplies go down quite strongly. And then because most global central banks were printing money with the kind of recession concerns we were in, so there was a lot of access to capital as well. That led to hedge money and fund managers making higher positions there. Energy transactions is another thing that led to a lot of buying in metals and crude, where we saw all-time highs, by the way, coming in for coal and various ferrous and non-ferrous metals. Markets do believe that the fundamentals are not solved yet. We still are looking at recession concerns. We still are looking at lower supplies. Demand from China is expected to go higher. And even as you wouldn't see a repeat performance of what we saw in 2022, but the belief is that the high volatility in commodities will just about continue, and many of these companies are looking at making further profits.
Phenomenal numbers, Manisha. Thank you very much for highlighting that. Need to slip into a short break. We'll come back, discuss market technicals. Rahul Mohinder of ViraTechIndia.com joins in next.
Okay, so absolutely flat trade. Mid caps are selling off a little more than large caps for the time being. So what to do in a market like this? Let's ask Rahul Mohinder of ViraTechIndia.com. Rahul, good to have you on the show. As always, all these mega events are out of the way and the market's completely flat. So what to do now?
I think part of the answer was gotten yesterday. The market was so range bound, between the 17,100 to 17,150 level. And I think traders are wanting to see the market, break through this zone. And if you're a short-term trader, what are you watching for today? Can you sustain above 17,150 and then move towards, 220 to 250? That's the real block hole. If you look at the last couple of weeks, 17,200 to 250, that's kind of the medium-term block hole, if I could put it that way. That's going to be the major breakout per se. But I think if I was a day trader, or if I was a very short-term trader for the month of March, I would still say that, look, hold on to long positions, keeping a 17,100 stop loss. We have much better odds of getting to 17,220 in terms of a price target. If I look at the Nifty Bank, the level I would be very careful from a slightly bigger perspective would be 39,600. That level should not be breached. We're still safely above that. And I think that's, where I feel that the market should get stronger from here. In terms of some stock specifics, before I come to trade ideas, just to lend to this index call of mine, I'd say two very important index heavyweights that I'm watching are Reliance and Unilever. 20 to 30 on Reliance is a very strong support, and 24.50 on Unilever. These are both levels one should watch carefully. Hopefully, we don't break these levels and we've kind of locked in a short-term bottom. So I think these are two levels which I'm going to suggest we watch even on these individual stocks to get that lead picture on the index. But coming to some trading ideas, I think technology has the greatest potential to kind of break out from here. And I may be early on this, but I clearly think that, after a good 13-14% correction on TCS from its peaks of February, we have finally probably looked at some kind of a base building formation. My sense is if you could buy now with a 3100 stop loss, the odds of seeing 3205 are highly likely. In the banking space, Axis Bank, I would use these intraday down dips to buy around 850, 855. Keep a stop loss at 847. If the stock really can break out from here, we could go all the way up to even 880, 885. So Axis Bank would be my pick within banking. And lastly, Bajaj Finance. This one could be a dark horse. We've seen a nice, clean, straight line move if I look at an intraday time frame. And I think we are probably headed to 6,000 plus levels on the stock. Keep a stop loss of 5,800 and go long on Bajaj Finance would be my call.
Rahul, thank you very much for that. Just to take the point forward on the technology names out here in India, the Nifty IT index is still down close to about 0.6%, but early in the morning it was down nearly 1%. So it started recovering from the day's low. Week to date, the Nifty IT index is down 2.8%, nearly 3%, versus the Nifty, which is down, which is absolutely flat. So the Indian IT companies have underperformed this week. The concerns are their exposure to global banks in US and in Europe, and if it's going to have an impact on growth, where the tech spends get delayed, decision-making gets impacted. That's what's weighing on the Indian IT. Accenture will be reporting their Q2 FY23 results today. And the question is, will they hold on to their annual guidance? Do they meet their Q2 guidance? Their Q2 guidance is for 6 to 10% revenue growth. Does Accenture meet it? And secondly, what happens to their full year guidance of 8 to 11%? Is there going to be any change in that? If Accenture brings down the guidance, then it will be seen very negatively for the Indian IT companies. Remember, BFSI contributes nearly 20% to Accenture's revenues. So Accenture, in a way, Accenture has part of its revenues coming in from consulting, but the other part of the revenues is where Indian IT companies play in, and Accenture's guidance, its performance this time, and commentary will be seen as a lead indicator for what Indian IT companies are likely to do in Q4. So that's something that you need to keep on the table. Get into a break. We'll come back and discuss the way forward with Sunny Agarwal of SBI Securities.
Hey guys, welcome back. You're still tuned into Trading Hour here on CNBC-TV18. For the market, it is as flat as it gets, just about managing to hold in the green. But it is the mid-caps where you are seeing a little bit more pressure today. So that one will come up for you. It's around 0.25% in terms of a cut. The Nifty Bank, however, has moved into the green right now. Quite flat, but it is at least seeing a little bit of a pickup today, led by the move seen in some of the private banks. But let's get a sense of where the markets could really move from here. We have Sunny Agarwal joining us from SBI Securities to take some questions on this. Sunny, thanks for joining us. This is Pavitra. With the big Q out of the way, the Fed moving to hike rates by 25 basis points, how do you see things moving from here in terms of what the global setup looks like as well? We've also, of course, been talking about the banking crisis in the US. How do you think all of this really sort of translates into what we could see for the Indian markets over here?
So basically, post this 25 bits hike by the Fed, what we believe is that the globally central banker are at the fag end of the rate hike cycle, and it may happen that for the next 6 to 9 months there may be one token hike of 25 basis point by US Fed, and post that there may be a long pause, and then as per the dot plot of US Fed, it is expected that next year there may be a 75 basis point rate cut by the US Fed. And coming to the India story, again, RBI is having a meeting in the first week of April. And historically, what we have seen is that RBI has been leading ahead of Fed in terms of rate hike. So maybe one more token rate hike from RBI in the first week of April, or maybe a pause by RBI. So overall, what I feel is that rate hike story or narrative for the global market is over, and henceforth, what are the country-specific factors that will drive the market? So one of the, having the key positive that has happened in the Indian market over the last 3 months is that the budget has been the pro-growth, so that's one of the positive factor for India. The tax collection has been robust, again that positive. Crude oil is trading at $75 as compared to $100 last year. If you talk to any engineering company, cap goods company, defense company, their order book are at record high. Rupee is stable, hovering in the range of 80-83. So what we believe is that amid the global gloom and doom, that's a lot of positive factor which is panning out for Indian domestic equity market. And once this negativity pertaining to the US financial crisis or any crisis which is panning out in US and Europe, it is settled, then we may, in overall outlook for Indian market, look positive in the medium to long term perspective. On valuation front, anyway, we are trading at 1 year forward 17 price to earning multiple. And if you remember, in the month of December, this premium to the emerging market indices was at a very high level. Although it continued to trade at 50 to 60% premium to MSCI emerging market indices, but the valuation gap has shrunk during the last 3 months. So I feel that at the current level, maybe large cap will consolidate for a few more months. But if you look at a few stock-specific ideas in the mid-cap or small cap, so companies in cap good, defense, or for that matter, auto ancillary company, auto company. So there are a lot of things which are panning out positively for many sectors, and there is a stock-specific opportunity in the mid-cap and small cap.
Sunny, many infrastructure companies are winning awards, order wins. So just today you've got GR Infra, NBCC, AG Infra. Do you track any of these smaller stocks in the infrastructure basket?
Yeah, so you are right that within infrastructure also there is a continuous flow of order across the construction space or real estate space. So definitely as a sector this looks good, but within infra we would like to be a very stock specific, very selective companies like PSP, HG Infra, for that matter, Power Make Project, the company which has got a good corporate governance practices, a clean balance sheet. So very few companies like NCC, Nagarjuna Construction. Few of the companies, yeah.
AG Infra, which has won a 925 crore order today, what's your target price?
Yeah, so although the company is not under our coverage, but what I feel is that over the next 2 to 3 years, looking at a healthy order book and healthy pipeline, entire infra space can deliver a 15 to 20% CAGR return over next 2 to 3 years.
Okay, so just talking about some of your other picks, Sunny, if you're looking at some names in the auto space, then what part of the auto sector would you play? We were just talking to some of the commercial vehicle manufacturers. They're looking at certain price hikes. On the other side, a company like Maruti is saying that higher cost of ownership, higher interest rates, they're making people a little uncertain about purchase decisions. So what about the auto sector? What do you like here?
Yeah, so within auto, what we like is that one is the passenger vehicle space and Maruti within that. So what we have seen is that for a passenger vehicle company like Maruti, the margins have bottomed out 2-3 quarters back, and now for the next 2 year margin will definitely expand. And at the same time, the order book is at healthy level. In the sports utility SUV, they have launched a lot of new products that will definitely help them to gain the market share. So Maruti is one of the stock which we like in the auto space. Within commercial vehicle, we like Ashok Leyland. So we have been seeing that even though the commercial vehicle industry is reporting healthy monthly sales number, but still the overall volume is far lower than the peak volume which these companies have reported in FY19. So there is a lot of leeway to go ahead. At the same time, there is a lot of tailwind for the commercial vehicle segment like infra story and so on and so forth. So Ashok Leyland is the one stock which we like. Then within auto, we like electric vehicle space. So companies like JBM Auto, Electra, for that matter, Sona, BLW. These are the companies which we like in auto sector.
Okay, all right, Sunny, thank you for some of those concepts and telling us the stocks that you like as well, with, of course, the usual disclosures. Good having you on the show. Thanks for joining in. Well, since we were on the subject of auto, there's been a lot of news flow, actually. I know, Rima, you've been looking at all these announcements. Yeah. Quite a few companies are hiking prices, and I think there's a brokerage report on M&M as well. You want to sort of club it all together for us?
So let me start with Hero MotoCorp, where the company has said that we will be hiking prices by up to 2% on select motorcycles and scooters effective 1st of April. Remember, yesterday, Tata Motors announced a 5% price hike for CV, and today even Eicher Motors indicated that there could be a price hike in the range of 2 to 5%. So come new financial year, cars, motorcycles, trucks, buses, all are likely to get dearer. But the reason I want to talk about M&M and the Kotak institutional report is that I was actually quite shocked and taken aback by the kind of growth projections and the big decline in their growth projections. So first, let me start with the UV segment. They're saying that growth in FY23 for the utility vehicles, UVs, was 58%. It's going to come down to 7 to 8%. That's the extent of a decline. The reason is cost pressures, because prices are going up due to the new emission norms. Pent-up demand is waning, and weakness in rural demand. So that's in the UV portfolio. 58% revenue growth this year comes down to 7 to 8%. On the other side, the tractor volumes. They're saying that they're anticipating tractor volumes will grow by 23% this fiscal year, FY23. It will come down to 5%, and there is a possibility that the El Nino, which could, impact the monsoons, and we could have deficient monsoons, that may further hurt the sentiment. That said, but we're still expecting a 5% revenue growth because the reservoir levels are fairly adequate, and the government usually supports spending to the rural economy ahead of the elections. So growth is going to come down quite significantly. So M&M, Kotak says, has fallen 17% from its peak values, and they're saying the near term is going to be challenging given the multiple headwinds that I was talking about. That said, they still think the stock is fairly attractive, which is why they've got a buy call on the stock with a target price of 14.75. But the reason I picked up this report is because I was actually taken aback by the decline in, the way the growth rates are going to come off next year.
Yeah, that's actually very interesting, and a very interesting dichotomy that they're talking about such a substantial decline in
58% comes down to 7 to 8%, right?
I thank you for pointing it out, because this is not normal that we see such huge cuts on expectations in terms of business growth. But a buy on the stock, and they're still retaining a buy despite the fact that M&M rallied, 40-50% in the last 1 year. It's come off, but it's still up. Yeah, it's still around the 11.
So they're saying the risk reward is attractive, right? After the 17% fall from the peak levels.
All right, that is Kotak Institutional Equities on Mahindra & Mahindra. Right now, we need to take a break. On the other side, we'll put the spotlight on loan growth in the banking sector. We will bring you our special segment, Fin Street.
Welcome back. Some of the IT stocks are moving to the high point of the day. So Tech Mahindra is now up 1%. TCS is green, going for itself. TCS up 0.4%. So IT is reversing some of its earlier weakness. Let's get to our special segment, Fin Street, where Abhishek takes a deep dive into the exceptional loan growth for the banking sector in FY23.
Well, in Fin Street today, let's focus on the loan growth, which has been phenomenally strong for the banking sector in FY23. So for the period ending 27 Jan 2023, overall credit growth was at 16.3% YOY, and non-food credit growth was 16.7% YOY. Let's take a deep dive into what has driven the loan growth and how it will pan out going ahead. Incremental loan growth on the non-food credit side for FY23 till now has been rupees 14.6 lakh crore. So in FY23, monthly credit demand up to Jan 23 has been at rupees 1.46 lakh crore, which is much higher than the previous best, which was recorded in FY20 of about rupees 1.4 lakh crore. And it is one of the best in many years. Which sector has driven the loan growth? Personal loans, which includes home loans as well, has been one of the biggest drivers of loan growth in FY23 so far. Services has been the next best segment to witness strong loan growth momentum. It formed around 31.5% of the incremental loans in the system up to Jan 2023. Agriculture formed around 12.1% of the incremental loans, with industry forming around 9.5% of the incremental loans. Talking about the best performing segment, personal loans, of the incremental loan growth of rupees 5.7 lakh crore in personal loans, 35.55% has been driven by the housing sector, which includes priority sector lending as well. And the second large part was from the other personal loans, which contributed 30% of the incremental personal loans. Vehicle loans and credit cards have done well too. Credit card performance in FY23 so far has been one of the best in the history for the banking sector with respect to outstanding loans, card issuances, as well as massive increase in ticket sizes. So services sector performance has been strong too. NBFCs switched to banks from money market as liquidity dried up and money market rates shot up. So trade also formed a substantial portion of the incremental growth in services segment. Shipping witnessed a decline in terms of incremental loan flows. Let's take a look at the outlook. Now, loan growth rate will soften a bit going ahead. Some part of the loan growth has been derived from lower principal repayment. Hence, when the repayment in principal starts to happen in the EMI, it starts to increase. We may see some impact on the loan growth as well. Now, capex demand is yet to come back. It may not come back in a high inflation scenario. Corporate loans may continue to see working capital demand from the lenders due to better rates than money market instruments. We can expect personal loans to continue driving the overall loan growth momentum. NBFC demand will remain healthy due to favorable interest rates from banks than other instruments.
All right, Abhishek, thanks a lot for getting us that complete roundup of what we've seen as far as the loan growth goes for these big banks. But with that, we do need to get into a short break on the show. You don't go anywhere because there's lots more market action coming up for you in just a bit. Hey guys, welcome back. The market is absolutely flat, but there has been an up move in some of these metal names that we have been talking about. So Hindalco is the top gainer on the Nifty right now. That'll come up for you. So that one holding quite well. You also have some from the consumer pack, so the likes of Nestle, ITC, which are looking good. But on the downside, it is all about the big tech names as well as Reliance. So Reliance, even though it's off the highs, it is seeing a cut of around 0.8%. And then you have the entire pack of big tech names, so HCL Tech, Infi, Wipro, which are really weighing on the market today. So that's what's going on as far as the market goes. But with that, we do have to wind down on this edition of Trading Hour. As we do that, here's some market opinion from Anish Sondhalia of Motilal Oswal Asset Management. Thank you for watching Halftime Report after this short break.
Within the next 2 quarters, I would believe that mostly all the negatives of the IT names would get priced in. It's a great time to buy IT, when particularly the sector has seen some very decent correction over the last 1.5 years. And, there is absolutely no interest. So the sector is seeing a lot of disbelief as far as earnings growth trajectory on FY24 numbers are concerned. Cross currency, which was a headwind in FY23, will likely become a tailwind going into FY24 and 25. So from that point of view, I would believe both IT and pharma are great buys at current levels. I would believe it's likely to remain an overweight sector for FY24 at least, even though earnings trajectory would be not as strong as we've seen in fiscal 23, but still it's going to be very decent and in line with or slightly better than what the total index, which is Nifty 50 earnings growth, is likely to shape up for fiscal 24. So I would broadly be a buyer on dips in the banking space, but more so on the private sector banking names as opposed to PSU names. In the PSU names, only State Bank of India.